So in this video, I want to talk about why cash flow producing assets are going to beat capital growth properties in 2026. Essentially, what we're seeing is a pretty crazy spike in demand. This has been going on for a little while, especially post-COVID. There's a lot of houses that are absolutely boosting in value due to a number of factors. What we're looking at currently in the Australian economy when it comes to housing is a massive supply and demand shift situation where we have an incredible amount of people that need somewhere to live and not enough houses. We needed to build like 10,000 houses yesterday just to come close. Essentially, what's happening is that people are scrounging for whatever properties they can afford. Now, there's that with working professionals and families trying to get into their own home, but what we're also seeing is a big shift in the first homeowners market as well. House prices are being pushed up by demand, and the supply is so low that people are outbidding, there's people overpaying for properties, and the whole economy is going up, which is doing a couple of things, not just to the housing market, but also to townhouses, units, and villas, and things like this. People are getting priced out so much of houses that they're then looking to alternative dwellings to actually satisfy their accommodation needs. This means a lot of the investment paths people were using in Australia, buying and holding properties worth 500,000, 550, that's not really happening anymore. Really, the properties that are being picked up for that kind of amount are going to be reno flips. And those are incredibly hard to find as well because every cat man and his dog is looking for a reno flip property, something torn down, dilapidated, just in a horrible condition to try and flip it. We won't get started on reno flips because that looks just like a bag of stress right there. In terms of the economy right now and the investment strategy of buy and hold, it's incredibly hard to achieve for a lot of people. A few years ago, I was working for one of the biggest buyers agencies in Australia, helping people build multi-million dollar portfolios. And essentially, we were looking at purchasing properties to help people get started with as low as $80,000 up to about 100 grand. What this was allowing people to get started with sub $500,000 properties. I know because we used the service before I worked for that employer to get hold of one of these assets. We purchased for 422,500, and then that grew over 2 years to 620. That same property is now worth in the 660s. But we sold that property because we realized one giant thing. You cannot eat equity. And one of the biggest factors around this is not only is the housing prices going up incredible amounts, and people getting into it are going to have higher mortgages, but the cost of living is huge as well. So there's one big element to this that people are missing, and they're relying on trying to get more income and higher salaries from their jobs. But what they're not realizing is that cash flow comes first. This kind of is backwards because a whole bunch of people think that you are looking to buy residential property. Say you buy a property for 600 grand and it's kind of out in the sticks. The rent is still costing you about $10,000 to $12,000 in negative geared money, which means it's costing you that much money, 10 to 12 grand a year to hold on to the asset because the rent isn't covering it. And your plan is to wait for that to grow in about 1 or 2 years, just enough for you to max out your debt again. When that property grows, you then take the money that it grew to out, which means your debt increases, and then you go and use that as a down payment on another investment property. And the idea is that you continue doing this on repetition. It's a very easy and simple strategy. But what a lot of people don't realize is there are so many glass ceilings when it comes to executing this strategy. Firstly, you have to be in a position where you are running your life extremely lean. This means no kids, or if you do have kids, you want to be an extremely high income earner, and your partner, if you have one, also wants to be an extremely high income earner. But if you're looking to add more freedom and balance to your life, and you want your partner or yourself to stay at home and spend some quality time with your family, then that means you might be a single income household. You will get stopped very quickly by the banks when it comes to getting into more debt. And rightly so. If they were lending you money and you were unable to fulfill that, you're going to be in a world of hurt. That's just one side of the coin. The other side is the debt that they allow you to get if you do, God forbid, have something happen and lose your income. Imagine growing a portfolio. Maybe you have 4 properties, right? And they're all costing you 10 grand a year. That's $40,000 in the hole every year, even though you're getting wealthier on paper, but you can't use that money. If you lost your job, not only will you burn through savings just through general high living expenses, but you also have to look at this side and say, well, I have a portfolio that is now draining my cash that I had in reserves extremely quickly. When I was talking to a sophisticated investor about the buy and hold strategy, what they told me was what they gave insight to was a little bit of a high level look at the strategy. It was pretty interesting because you are just buying a property, data, area, hotspot, whatever. Your only strategy for that is to hope that it goes up in value. To me, if you take the data out of it, that's what you are doing. Your active part in that strategy, it is to hope that it increases in value, does not go backwards, and one day you might be able to sell that, realize the gain, and then do something with it. But that is years down the line. Now, eventually, with this strategy, what you're looking to do is then transition from residential asset growth into commercial. Commercial assets are quite a bit different, and the risk is higher, but if you do it right with buyer's agents, they can produce cash. However, the risk is also incredibly high. In terms of due diligence, the checklists are almost double. You are going to spend 5, 10, 15, 20 years to essentially take all the money that you've built in your residential portfolio and risk a large chunk of that into a commercial asset that might give you anywhere between 6.5 and 8.5% yield. Now, that used to work incredibly well and you could do it quite quickly. However, now, why would you wait that long? Also, think about the risk that that actually involves. I speak to people every day who have property portfolios, and properties that grow in capital are definitely a good idea, but they are just one piece of the puzzle when it comes to building a sustainable, wealth generating asset portfolio. The other side of this that people think that's going to take 15 years to achieve is actually able to be achieved much, much sooner, and that is cash flow. Now, this is incredibly important, and a lot of people miss this because they think that, look, I've got a job, I make a living, that's my cash flow, that's everything that I need, and that's where it comes from. But what they don't understand is the risk that if you lose your job for whatever reason, or you decide to take a long holiday, you are trapped in that position to pay for your debt. The biggest play when it comes to actually getting freedom is to put cash flow first. How this works is you might not have the equity to jump into commercial straight away, so you need to look at alternative strategies. And that's exactly where rent to rent fits in like a glove. Essentially, you are approaching a landlord with an asset that is incredibly desirable, and you are saying, I would like to rent this property from you. And in exchange, guaranteed rent, we're going to be doing soft maintenance, we are going to be doing higher than average rent sometimes, and absolutely not a peep you will hear from us. In return, we need the permission to sublet this property, make minor modifications, improvements, and renovations. And we also need the required permission to do any planning that we need to get this through council or whatever strategy we're running. We need these three elements. Once we have these three elements, we can then assess where we are and what strategy works best. With rent to rent, you are able, without owning an asset, to get into a position where you are generating cash flow from day one in a matter of weeks, and that would trump your investment that you would get in 15 years. Now, if you are looking at getting a commercial property and say that property is worth $3 to $5 million, and your yield might be gross, maybe $20,000, $30,000 if you're lucky, that sounds incredible. But with rent to rent, you are able to profit much quicker and higher with much less risk. That looks like taking control, not buying, but taking control of an asset worth $2, $3 million, and you are able to control the business inside of that property, which means that property, depending on the strategy and location, can generate between $35,000 and $60,000, in some cases upwards of 80 and 100K from just one property. The barrier to entry for this is under $50,000. I'm talking you could get started for 10, 25, 35K, depending on the strategy that you want to run with. And this will allow you to not only have cash flow coming in, but actually allow you to get some breathing room, some buffers in place, some salary supplementing going on, and actually allow you to move forward with building out your portfolio. The biggest and most important step is actually the foundation, which is cash flow first. It is the key to continually growing a profitable portfolio in Australia. That is why cash flow trumps capital growth to get into the market for your first property. In real estate, when you are just starting out, or even if you have an established property portfolio, it is one of the most powerful strategies that you can implement. If you are interested in learning more about this, click below. There's a link to book in a call with my team, or jump straight into the free community. And I've got free mini courses in there that you can just dive into and understand more about what exactly rent to rent is and how it might be able to benefit your situation. If you found this video interesting, you liked it in any capacity, feel free to like and subscribe and follow along for more content just like this. Thank you, and we'll see you in the next one.